Now the order is. Now you're good.
Testing, testing. Are we good?
Yeah.
All right, we are live. Okay, everyone. Cool. Welcome to a weekly tax strategy live Q&A. Let me know in the chat if you guys can hear us. We've got a new setup today. Trying to get really fancy so you guys can get a great quality video, great quality content, and everybody can see the board clearly, hear me clearly. Say hello in the chat before we get started. We got Mariana's here. Mariana, say hello.
Hey, everyone.
All right, Mariana's going to be reading out your tax questions. So this is live Q&A by me, Boris Musheyev. For those of you that don't know, I'm a tax advisor, and every week on Thursday at 12 p.m. Eastern Time, I go live to answer any tax questions. And I have a gift for you, right? So you can, by the end of the day today, get my free book, S Corporation Tax Secrets book. This is currently selling online for $9. If you participate today with your questions, you get it for free. We also have a Thinking Outside the Tax Box. Now this baby goes on Amazon for about $21. Today, it's yours for free. We'll mail you both of these copies. Now, the third prize that we're giving away is a 3-year look back. Exactly. We get to review 3 years worth of your business and personal tax returns, okay? Now, in order for you to win, you have to be on live until the end of the call, because when you win that, we'll actually give you instructions how to follow through. We had a winner last week, and we're gonna have a winner this week as well. Perfect. Let's get going with the questions. Is there a way I can see a chat on the screen also? Perfect. Let's do it. Let's go with the questions.
Guys, we need some questions.
Oh, we don't have questions?
We don't have questions yet.
All right, cool. Then I want to start off with something very interesting that everybody really should know about. Now, here's the thing. I don't know if you guys heard recent news, but a tax advisor got arrested, okay? Let's talk about that, okay? Tax advisor getting arrested. Now, while we have some people coming in here, now, I get asked a lot of questions by prospects, the people that want to work with us, or even by our own clients. Hey, Boris, I see this YouTube video, shorts on Instagram or Instagram Reels, on Facebook, all of these videos. And they say, Boris, apparently I can set up a trust, then I can set up another trust, then I can set up another trust, and all my business profit is going to go into one trust, and then it's going to go into another trust, then it's going to go to this donation charity trust, and then the trust can pay for all of my expenses, and everything is tax-free. I actually attended a mastermind event a couple of years ago where the guy was presenting this, that his company does that, and I was sitting in the back seat. I was like, I don't know about that, right? Because Ayers clearly says on the website, you can't use trusts to do stuff like that, to hide your income evasion. So now, this tax advisor is getting sued and arrested by the IRS. That person that was setting up these types of schemes, the whole team of accountants, bookkeepers, tax advisors. Now, I always tell you, you got to work with a tax advisor. That is true. You've got to work with a tax advisor. But when they tell you, hey, when you set up all these shell trusts and you pass income from one entity to another trust, to another charity, and pay for your personal expenses from the trust, and you can write your entire life off with this, that tax advisor, you should and you must question, and you should seek second opinion, okay? Super crazy. We're going to be sharing more information on that, but I wanted to share it with everyone. Now, hello everyone. For those of you that start coming in, let's get going with the tax questions. Please ask me tax questions. Anybody that asks tax questions today is going to get my free books. Okay, we're going to mail that to you. And the third prize that we have is a 3-year look back. We'll review your business and personal returns. So you have to stay until the end of life to find out how to get that. All right, let's get going with the questions, Mariana.
All right, we have a question from Mike D.
Mike D, what's going on? I think I know Mike D. Doesn't he ask questions usually? Mike, say hello in the chat. Let's get going.
Mike is asking, regarding cash back from credit cards, is cash back taxable? Are miles points better than cash? Are cash back websites treated the same?
Okay, say it. What's the last part? Are
cashback websites treated the same?
Okay, great question, right? Because we've released a video. Mike, by the way, thanks for asking that question. By the way, can everybody hear me okay? We've got this new setup going on. Say yes in the chat so we know everything is good here. So Mike is saying, Boris, I watched the video on credit card rewards. And for those of you that haven't watched it, go check it out, because over there I talk about how your credit card rewards are absolutely tax-free. Especially if you're a business owner, you don't want to use your credit card rewards to offset your business expenses. Instead, you should use your credit card rewards for your personal expenses. Okay, now Mike is asking, Boris, what about cashback websites? Are they tax-free? I don't know much about them, Mike, to answer this question and give you like a right answer. If this is a cashback website where you buy something and they give you a cashback as a rebate, for example, or really just a cashback like a credit card, then I would assume it's not taxable. I would want to look more into it. Or are you doing it as a business? Because some people do it as a business, and I've heard about things like that. Then in that case, it would be taxable to you. So give me some more context on your question. Next question.
Kins, how about QBID? Is there an income limit?
QBID, yes. Who asked that question?
Kins.
Hey, Kins. How do you spell Kins?
K-I-N-S.
K-I-N-S. Kins, say hello in the chat. Okay, awesome. So is there a limit on Qubit? So that is actually a great question. We released a very detailed video on that, but over here we're going to cover that. There's two types of businesses for the Qubit. For those of you that don't know what Qubit is, it's qualified business income deduction. In 2017, President Trump reduced the tax code for corporations to 21%. What about small business owners such as yourself? Okay, they gave you what's called a 20% deduction, which is called Qubit. If you're a pass-through entity, you get 20% written off. So 20% of your net profit generally, okay? Now, what happens is that for the purposes of Qubit, Kins, right, I hope you're listening to this one, there's two types of businesses. I'm going to write there is regular business and there's SSTB, Specified Service Trader Business. SSTB are generally accountants, attorneys, healthcare professionals, certain consultants. Certain doesn't mean you are a consultant. A lot of people are consultants. Don't worry about that. So what happens, they have a different limit than they are, right? If you are a regular business, you don't have a limitation. So if you're married and your income threshold is over 400,000 and change, I'm going to use the number 400,000 here, 400,000 and change, and you are a specified service trader business, you do not get a Qubit. Now, if you're a regular business and your income is over 400,000 and change, I don't remember those exact numbers, you still get qualified business income tax deduction. The only reason you would not get qualified business income tax deduction if you're over this threshold is if you do not have payroll on the books. So one of the planning aspects that you have to do if you want to qualify for Qubit is to make sure you have payroll. I have a question for our video editor. Is there a way we can flip the video because I can see the other side of me and it's kind of, it's off, or is this good? Like the mirror the image. No. Okay, let's put the camera back. All right, cool. Mariana, we have a next question?
Yeah, I have a
better angle.
Okay.
I have a second question from Kins.
Yeah.
I'm just gonna go ahead and
Kins,
ask it.
what's going on? Let's get that ready. Yes.
For S Corp,
Yeah.
as an employer contribution for solo 401k, is it considered company expense?
For S Corporation. Kins asking, right?
Yeah.
So solo 401k?
Yeah.
Okay, solo 401k. Is it a company? Is solo 401k a company expense? Great question. Solo 401k is divided into two parts. Okay, there is an employee contribution and employer contribution. The employee contribution, you, as an owner of your own business, get to put away $22,500 from your W-2. That is a personal contribution. That is not a business deduction. Okay. What happens on the employer side, you or your business, right, can match 25% of your W-2 salary, okay? Once that does happen, it becomes a business deduction. Hope that answers your question.
Question from Tim McKee. If my LLC elects an S Corp in October, will it be effective January 1st, 2024?
What's going on, Tim? Say hello in the chat. Okay, by the way, do we have questions rolling in? What's going on there?
We have questions.
Okay, perfect.
Yeah.
So Tim asked what question exactly?
If my LLC elects an S Corp in October, will it be effective January 1st, 2004?
Great question, right? So 2023, you mean?
He wrote 24.
Okay, Tim, I think you made maybe a typo. Maybe you meant 2023. So for those of you that are on this call, first of all, to elect an S corporation status, the deadline is March 15th of each year. So if you want to be an S corporation for 2023, you have to elect it before March 15th. Now, if you're late, that's okay. IRS still loves you, okay? You actually have the whole year to elect it. So in case of Tim, okay, Tim says, hey, if I elected in October of 2023, as of what date will I be considered as an S corporation? If you elected for year 2023 and you're a calendar year taxpayer, which most of you are, January to December, then it will be considered as if you are from January. Cool. Hope that answers your question. Next question.
Question from Robert Ayers. Tax question. If you form an S Corp mid-year, say July, how are retirement contributions handled for tax purposes?
Okay, who's asking the question?
Robert Ayers.
Robert, say hello in the chat. Robert, is this your first time with us? I don't remember your name coming up with the question. Say hello to in the chat. Let me know if you're a subscriber. By the way, for those of you that are participating today, we're giving away 2 prizes. I'm tired of picking up these books, but we'll do it again. All right? We got an S Corporation Tax Secrets book. We'll mail it to you. This baby goes online for $9. It's yours for free. All you have to do is just ask questions. That's it, guys. The second thing is thinking outside the tax box. This baby goes on Amazon for $21. Today, it is yours for free. Now, for those of you that stay till the end and you participate the most, the third winner is going to get a 3-year look back. That's right. If you win, we will review personally your business and personal tax returns for the past 3 years by a tax advisor. The only caveat to that is that you have to be a business owner to meet that, to get that. But let's get back to Robert's question. Robert asked what again, Mariana?
If you form an S Corp mid-year, say July, how are retirement contributions handled for tax purposes?
Okay, so I'm going to assume, Robert, that you are not an LLC, like the worst case scenario. You were an S corporation and didn't have any entity, and you decided to be an S corporation in July. How's the 401k, right? He said, solo 401k or retirement contributions,
yeah.
There's no limit. You still can do $22,500 from your paycheck as long as you have enough money on your W-2, and your company can match you 25% of your W-2. That's it. You're not limited to how much you can because you formed an S corporation in the middle of the year. Next question.
I think this is a follow-up from Robert as well. It's a second question from, do you pay first half of year under old plan and then half year under S Corp arrangement?
Good question, right? Good question. So again, that depends, Robert. So Robert is asking, Boris, if I'm going to become an S corporation in July, for example, right, of 2023, for the first half year, I was not an S corporation. Now, if you were a sole proprietor, that means you were not a single member LLC and you created an LLC and became an S corp, then you only do a salary for yourself. That reasonable compensation piece would be from July to December. Now, January to June 30th would be Schedule C, right, which is sole prop. Over here, we're going to have a salary. Now, if you were a single member LLC and now you became an S corporation in the middle of the July, then the salary would be done for the whole year. Robert, let me know if that helps or answers your question, and say hello in the chat. Next, what else we got?
Question from Steven Anderson.
Steven, what's going on?
Does an LLC that's taxed as an S Corp have to file like a regular S Corp?
Does an LLC that taxed as what?
That's taxed as an S Corp,
yeah,
have to file like a regular S Corp?
That's correct. If you're an LLC and you chose an S corporation tax entity, you must file Form 1120S. Okay, this form, this tax return is due by March 15th of every year. If you file for an extension, it'll be due on September 15th of every year. Next question.
Okay, I'm gonna read out these comments. Craig says, sounds better and looks better than previous versions. Woohoo!
All right, good.
Okay, question from Purvi. Can you contribute to a SEP Roth IRA in 2023 for 2022 tax year?
Yes, if you haven't filed your taxes personally, not on the business side, let's say if you're a Schedule C or single member LLC, you still can contribute for 2022 in 2023, which is right now. But if you have an S corporation and you already filed your S corporation tax return because it was due on September 15th of each year, then it is a little bit too late to contribute. Next question.
Question from New York live streamer. What should I do if I set up an S corp 3 years ago, but I found out now that the IRS has my corp as a C corp? The problem is the last 3 years have been filing an S corp by mail.
Okay, great question, right? Everybody, I want you to pay attention to this question. So we've got the New York State live streamer, right? What's his name? Let's get his name. All right, cool. So his question is, I have an S corporation, let's facts, right, for 3 years. 3 years. Filing as an S corp for 3 years. But IRS does not have him, does not have as S corp. Now, this actually happens a lot to a lot of business owners. As a matter of fact, we have a case right now that is ongoing with this, and this is an easy fix, okay? Now, here's the thing. If you were an S corporation, you've been filing as an S corporation for 3 years, or you thought you're an S corporation, but IRS doesn't have that, first of all, the question for you is that, do you have proof or any type of a record to show IRS, hey, I did send in a request to be an S corporation? And if you don't, you can still try to fight your case. You can write a letter to the IRS with your S corporation election and say, by the way, we have been filing as an S corporation for 3 years. All the shareholders of an S corporation have been reporting income consistent to the rules of the S corporation on their business tax return, and have all the shareholders sign it. It's a little bit of a lengthy process. It requires a letter from shareholders, a letter from the corporation, Form 2553. Now, if you're not working with a tax advisor, I recommend start getting a tax advisor for yourself, because if you're working with a tax preparer, that's exactly what's going to happen. The IRS is going to reject the return because they don't have you in the database as an S corporation. The preparer doesn't really know what to do, and they find an easy way out, and they mail your tax return. Really, the root of the problem is that IRS never has a record of it. Sometimes when you do file for an S corporation to get that election, IRS loses that election. They are completely understaffed most of the time, and they get to it late. Now, if you're lucky, you'll get an acceptance within 60 to 90 days. If you're not lucky, one of our clients right now who got his acceptance 3 years, okay? From 3 years ago, he just got his acceptance, okay? So you want to file that 2553, retain proof that you filed it, either mailed it or faxed it. File your return as an S corporation. Doesn't matter if IRS have you as a database or not. And if IRS says we don't have you as a database, you can pretty much put in a compelling argument that you are an S corporation. I can tell you right now, this case could be a win. Next question.
Question from Mayra Serrano.
Hello, Mayra. Say hello in the chat.
What is the disadvantage of using the home office deduction? Is it true that the depreciation percentage would be deducted when I sell my house?
Okay, so this is Mayra. Did Mayra say hello? We're not answering her question until she says hello. I'm kidding. So what is her question?
What is the disadvantage of using the home office deduction? Is it true that the depreciation percentage would be deducted when I sell my house?
Yes. So Mayra is asking the following question. Boris, all right, I watched your video about taking a home office deduction, and looks like this is a great strategy. But I've also heard from other sources other than you, Boris, that if I deduct my home office, there's something that I take as a, let's change that, depreciation on my home, okay? And when I do sell my home, I'm going to pick up that depreciation as an income. Can we zoom out a little bit? I will take that as an income. That is correct. If you take home office deduction and you take depreciation on your home, when you do sell your home, now generally speaking, there's personal residence exemption. If you're a single individual up to $250,000 in gain on your personal home is not taxable. If you're married, up to $500,000, whatever you made on your house, is not taxable if it's your personal residence in the last 2 out of 5 years. Now, if you used home office and you were deducting a portion of the purchase price of your home, then out of this exemption, that part that you depreciated will be recaptured. So, great comment, Mayra. Next question.
Douglas Ivy is asking, can you claim the Augusta plan in a room in your home that is not part of your home office?
Yes, you can. So, this is Douglas. What's going on, Douglas? Say hello in the chat. Show some love. By the way, guys, I do not see likes or hearts. Can we get some likes and hearts over here, please? So we can have YouTube promote this video and other business owners such as yourself can come and learn about a tax strategy. Now, Douglas is asking, Boris, I want to know if I could use Augusta tax strategy on one room in my home that is not my home office. Now, for those of you that don't know, Augusta strategy basically allows you to rent your home up to 14 days tax-free and not pay any income tax on it. I just did a video on it last week. I went through entire detail how to take advantage of this tax strategy, avoid being audited by the IRS for this tax strategy. Okay? Now, he's saying, Douglas is saying, Boris, I have a home office in room 1, and I have a second room where I conduct my meetings for my business. And, you know, I'm assuming you meet with your vendors or your employees or whatever that may be. Can I use it for Augusta? The answer is 110% yes. Next question.
Okay.
By the way, guys, whoever participates today with your questions and asks the most questions, we're sending you these 2 books, okay? S Corporation Tax Secrets. You've got a Thinking Outside the Tax Box. And the third winner is going to get a 3-year look back where we review your business and personal taxes, and it gets reviewed by a tax advisor. Next question.
Okay, Kins is asking, how about defined benefit? How can I take advantage of that?
Defined benefit? Ooh, all right. So, who's that, Chris?
Kins.
Kins. So, Kins, I see a lot of questions coming from you. It looks like you're going to be one of the winners. I don't know. Mariana's making that decision, by the way. Okay, not me, Mariana.
Leave it on me.
Yeah, can send her hate emails. Okay, all right. Defined benefit plan. So defined benefit plan, for those of you that don't know, it's basically another retirement account, but on steroids. Okay, defined benefit plan can let you put away, if I'm not mistaken, up to $280,000 into a retirement account. It depends on a lot of factors. Okay, first of all, the factors are dependent on your W-2 salary in the past 3 years, your age, other employees, and so forth. And this is a retirement account that you pretty much get married to, and it's very hard to get a divorce from it. Now, when you set up a 401k, a SEP IRA, a solo 401k, you get married to it, and you can get divorced anytime you want to. Defined benefit plan, you kind of stuck to it. I believe it's at least 5 years. Otherwise, there's some hefty penalties and so forth. And Kins is asking, how do I set it up? You want to make sure, number one, you work with a financial advisor that specializes in this. But don't run signing up for it right away, because financial advisors say, oh yeah, sure, we can put away, you know, this much amount of money for you. No, give them the entire payroll census. How many employees? What is the age of each employee? What is the salary of each employee? What is the title of each employee? All of this plays into effect, because under the defined benefit rule, you may be obligated to contribute a lot of money to one of the employees depending on their age and so forth. So careful examination of this is super, super important. Next question.
Okay, I'm guessing this is a comment from Mike D. Cashback websites usually caused by resellers and drop shippers. Website will give you a percentage of the amount spent at a retailer. Full price is paid on the retail website, and almost all of them do not issue 1099s.
Yeah, okay. Read that again. That was Kins, right?
Mike D.
Mike, yeah, this is actually a good point, Mike. Okay, let's read cashback, right?
Cashback websites are usually used by resellers and drop shippers. The website will give you a percent of the amount spent at a retailer. Full price is paid on the retail website, and almost all of them do not issue 1099s.
Yeah, so because you are in business and you're doing this for the merchandise, for your merchandise as a reseller or a drop shipper, you basically would have to pay taxes on those rebates, or you're reducing the cost of your inventory. That is the way I understand it based on the comment that you're giving me. Again, this is, so you're buying from a certain vendor that's giving you a cash back when you spend a certain amount of money with them. That is pretty much, instead of an item costing you $100, it's costing you $95, so to speak. Okay, so you're reducing the cost of your item. That means if you sell the item for $150, your profit on that item is not $50, but $55 instead. I hope that was clear, and I hope I do understand your question here. Next one.
Question from Steven Anderson. I'm going to be running a tour business.
Wait, tour business. Steven, say hello in the chat before we continue the question. Hello, Steven.
I'm going to be running a tour business in New York that will also provide housing for those that choose to book with us. What business structure should I use?
For New York, what business structure you should use? Loaded question. All right, Steven. So Steven says, I'm going to have a tour business and I will provide housing. So when you say housing, I'm a little bit not clear on that. I'm going to assume that you're either going to let the guests or the tourists, right, stay in a hotel. And what type of business entity structure you can be. Now, when you say New York, did he say New York or New York City?
He said New York.
New York, right? So there's a big difference, guys, for my New Yorkers. I'm a New York myself. Okay, there's a big difference. Now, here's the thing. When you are in New York, S corporation, in most cases, right off the bat with $80,000 profit in the business is a better option. I've made a video. We talked about it extensively on last live Q&A. Now, if you're in New York City, being an S corporation is not as simple, because when you convert to be an S corporation, New York City says, no. We don't recognize pass-through entities. Therefore, we're going to continue taxing you an extra 9%, which is a corporation tax rate. You basically, as a New York City resident even, get to pay double taxation. Okay, so what business entity should you set up? Steven, it's a little bit outside of the scope of this live. I would strongly recommend you speak to your tax advisor, not a tax preparer, not an accountant, not a bookkeeper. Please, got to speak with your tax advisor and have different options, right? You could be an LLC for your first year, maybe an S corporation for your second year, and with some industries and some businesses, being a C corporation in New York City is actually popular, right? It really depends. That is a loaded question, especially for the state of New York. Definitely speak with your tax advisor. Next question. By the way, can we get some love, some hearts, some likes over here? What is going on? Let's go. By the way, let me know in the chat if you're currently a subscriber to our channel. Say subscribe so I can see. For those of you that are watching replay, hey, we're also picking a winner from the replays as well. So make sure you participate with your questions in the replay. Let's go.
Question from Aaron Tito.
Aaron, what's going on?
Husband and I have an S-Corp. It is my only income. He is a full-time salary W-2 for another company. Can his reasonable salary be hourly as he does work, or could the salary be part-time?
Wait, this is Aaron, right? Mm-hmm. And give me the facts again. They have an S corporation.
It is her only income.
Okay, Aaron.
Yeah.
Okay.
Her husband is full-time salary W-2 for another company.
Okay.
She's asking if his reasonable salary can be hourly as he does work, or could the salary be part-time?
From the S-Corp, I'm assuming.
Yeah.
Okay. Great question, Aaron. So these are the facts, guys, right? Aaron has an S corporation. Her husband is a W-2 employee for another company. She's saying, Boris, my husband also works for an S corporation. Do I also need to do a reasonable compensation for him, just like the owners of an S corporations go through? The answer is no. If you are the only owner of an S corporation, Aaron, your husband can just get paid for the hours that he puts in. I prefer your husband to get paid the least amount of as possible. So whatever work that he's doing, if that work on the market is $20 an hour, pay him $20 an hour. Don't pay him $50 an hour because you love him, okay? We don't want to do that. We made a video why you should not be hiring your spouse, okay? So that is my answer to you. Now, if you say, well, Boris, I want to be able to maximize my retirement contributions for my husband, baloney, okay? Baloney. You've got to work with a tax advisor to see, hey, if I pay my husband on a W-2, which means I have to pay extra Social Security taxes, am I going to save money by putting money into the retirement account? Depends what tax bracket you're in. And retirement account means taxes later. The money is being deferred. So be very careful, everybody, before you make a decision to put a spouse on payroll for no reason, just because you think it's going to benefit you. It is not. Definitely speak with your tax advisor. Definitely watch my video that we released a couple of months ago. The subject of that video is called Do Not Hire Your Spouse. Next question.
Okay, this is a clarification question. Thinking Outside the Tax Book on Amazon has one that is co-authored by you and 20 others. Is that the right one to order, or there's a specifically one completely written by you?
That is correct. The Thinking Outside the Tax Box is co-authored by me and other professionals in my field. That is the correct one to order from Amazon. Next question.
Kins is asking, if I have a high pay W-2 and high income 1099, is it worth it to form an S Corp?
All right, we're going to get a little bit technical and crazy over here, okay? So this is a great question. So Kins is asking, so let's talk about, let's dive deep into Kins' facts, okay? So he has a W-2, high paying, right? And then what's the next thing?
High income 1099.
He's also high income 1099.
Is it worth it to form an S Corp? So high pay W-2, high income 1099.
When you say high pay W-2, Kins, I'm going to assume that it is over $160,000, okay? Just going to assume that when you say high. And then you've got a 1099. And you're like, Boris, should I turn my 1099 business into an S corporation? Is that beneficial? Here's what I'm going to tell you, Kins. And I'm going to get a little bit technical and geeky over here, but since you asked these questions, you need to follow through with this. You see, when you work for somebody, even for your own business, there is a limit how much you can pay Social Security and Medicare tax, okay? You pay 6.2% of Social Security and Medicare tax. Now, you pay that as an employer and as employee of yourself if it's your business. And then there's 1.45% of Medicare tax. The 6.2% gets stopped when you reach $160,700, I think, this year. That's the threshold. That means whatever W-2 job that's paying you, if they go over $160,000 in your salary, guess what? You're going to stop paying this tax. And your employer also will stop paying this tax, but your employer is also liable to pay this. Now, when you turn your own business into an S corporation, your 1099, well, guess what? You're now going to pay 6.2% once you're over $160,000 overall from all the jobs combined, but your business will continue to pay it. IRS doesn't care how many businesses pay you. They care for you as an individual in this case. So when you are making this decision, I strongly recommend speaking to your tax advisor so that calculation can be assessed to make sure that it really is helping you or not helping you to save money on taxes. Because as a 1099 person, you are entitled to exactly same tax deductions as an S corporation, C corporation, partnership, even a sole proprietor. A lot of people think, oh, I'm going to be an S corporation, I can save money on taxes. No. Or meaning to say on deduction, I can deduct more, excuse me. If I'm going to become an S corporation, I can deduct more. Not necessarily, okay? Maybe with 1 or 2 deductions, but generally speaking, any business entity type you are, even a sole proprietor, you can still get the same deductions, even same retirement contribution. I hope that answers your question, Kins. Next question.
Question from Dave.
Dave, what's going on, Dave? Dave, say hello in the chat.
I am utilizing the home office deduction in my 5-bedroom, 4-bathroom home and have a dedicated room in the house for my home office. I also rent a room in the home via Airbnb. Guests only have access to that bedroom and an ensuite bathroom and enter via private entrance. They do not have any access to the rest of the home. Oh, I guess that's a comment. Yes?
I really don't hear a question here, but I would like to comment on this because this is a great example and a strategy that we can talk about here. So this is Dave, right?
Yeah.
He said 4-bed?
5-bedroom, 4-bathroom, and one of the rooms is a dedicated room for a home office.
I don't know why I'm writing into my fact sheet that he has 4 bathrooms, but we'll go with it. Okay, so he has a home office, okay, in one of the bedrooms, and another bedroom he rents on Airbnb.
Yes. And guests only have access to the bedroom and an ensuite bathroom.
So this also has a bathroom. We'll put it in our fact sheet also. Okay, perfect. Okay, so here's the thing. I hope you're utilizing home office, which I think you said you do. So that's great. Okay, now you've got an Airbnb, which is also good. Now what happens with an Airbnb actually, here's the thing. If Airbnb produces a loss for you for whatever reason, that loss can be deducted against your W-2 or business income if your Airbnb, you participate 100 hours in a year in it, meaning you actively participate, and I'm assuming you do because it's in your own home, and your average stay per tenant is 7 days or less. Okay, so for example, tenant 1 stayed with you 2 days, tenant 2 stayed 10 days, the average is 6 days. You qualify for these rules. Any loss from this can be deducted against your W-2 or business income. Okay, I hope that's clear. Another thing that you can do, you can dip into a depreciation expense for your home office, and you can also take a depreciation expense for the Airbnb portion. I hope that was helpful. Next question.
Hi Boris, I'm here now, got on late. That's Jason Thomas. Okay.
Jason, what's happening?
Oh, I have follow-up questions, I guess, from Dave. I do not otherwise rent anything in the home. We live in the remaining space full-time. Given this setup, assuming there is nobody booked in the Airbnb, can I rent the whole house to my own business via the Augusta exemption, providing I otherwise properly charge a fair market rate, documenting the meeting activity, and invoice through the business? The
answer is yes. David said, Boris, we erased the facts from the board. He's like, I've got a 5-bedroom home. 1 bedroom is home office. Another bedroom is Airbnb. The rest of the 3 bedrooms I live in, and I've got a living room and so forth. Can I use it for Augusta tax strategy? Rent it to my business up to 14 days? Proper documentation, follow all the rules? The answer is yes, Dave. It's an amazing question. I'm happy you have such a great tax strategy going. Next question.
Eddie Arshide is
Eddie,
asking,
what is going on? Say hello, Eddie. Say hello in the chat. We're not reading his question until you walk in the door. Look, that's right. All right, anyways, let's go.
Is it better to use 1 car 100% for business or 2 cars 50-50? I'm thinking of buying a second, nicer, luxury car for showing properties on the weekends. Currently, I'm deducting 1 car 100% under mileage.
Okay, so Eddie's saying, Boris, I've got 1 car in the business. I'm using it for the business. Now I just want to get a little bit fancy and show off and drive around my second luxury car, whatever that may be, because I work in, I'm guessing, an upscale neighborhood, so you need a luxury car, whatever that may be for your business deduction. 2 things to consider, and I would not take this advice from this YouTube video and run with it. I would speak to your tax advisor, but these are the 2 things you want to consider, okay? Thing number 1, did you write off 100% of the purchase of your first car? If you did and you dropped the business usage, you have to recapture the depreciation that you took and pay tax on it. Then you buy a second car. Is the second car more expensive? Is it going to give you more deductions than the first car? And so forth, right? Cost-benefit analysis. If you're doing it to save money on taxes, no, Boris, I want to save money on taxes. That's why I want to buy a second car. Well, is it ordinary, right? We have to now follow ordinary and necessary rules. Ordinary, necessary, and reasonable. Now, is it buying a second car and switching the first car to 50% use from 100? I'm not convinced necessarily that it is going to save you money on taxes or a significant amount of money that for you to go through this and have a burden of 2 cars. If you're accomplishing your work enough with 1 car, don't go ahead spending money on the second car. I'm going to be releasing a YouTube video on how IRS can pay for your Ferrari, okay? And the concept of that video is that instead of putting money into a new car, even a down payment into a new car, which depreciates in value as soon as you leave the parking lot, why not put that money into something that you can invest in, such as real estate? That real estate will produce cash flow for you to then buy that car. Everything flows through kind of tax-free because you can structure your real estate in a ways that you don't pay taxes on that passive income and so forth. I know I covered a little bit too much here, but these are the things I would consider. Next question.
Question from Marlene Moreno.
Marlene, what's going on? Marlene Monroe, you said?
Moreno.
Oh, you have to be careful how you read out those names, Mariana. Okay, question from Marlene.
Marlene asks, how do I report a sales of stocks in a corporation and in the LLC? If the same treatment, is it the same treatment if I transfer the stocks or interest?
Okay, I'm going to try to answer your question. Marlene is asking, Boris, how do I treat the sale of a stock in a corporation or a partnership? She said LLC, right? Mm-hmm. So it's capital gains. If you're selling your ownership stake in a corporation to another person and you held that interest or ownership stake for more than a year, it's capital gains tax. Now, transferring to another person, or is it transferring to your own self or to your own trust? I would need more clarification on that, but the sale would trigger that, okay? Now, yep, next question.
Question from Jason. What is the way to figure out basis for the S-Corp with a single shareholder and had zero initial investment the first year? And a second part.
This is Jason?
Yes.
Okay, what's the question?
What is the way to figure out basis for the S-Corp with a single shareholder and had zero initial investment the first year? And the second part of the question is, what is an example of how to track that on the AAA/OAA? Okay,
I'm sensing that Jason is an accountant. This is a very technical question. So we're not going to answer the second question where it says M2 because a lot of business owners don't really understand the accountant's language. M2 schedule is something that comes from your tax return. But for a shareholder basis with an initial investment, the basic calculation is that we have an initial investment. He didn't put anything into the business, but we've got money coming into the business, which is the income, right? Minus expenses. So that gives us net income. And if there's any distributions, we'll minus that as well. Now, and then you have basis. Now what happens is that all tax softwares by now calculate the shareholder basis. And I say by now because last year, for 2022 actually, Ayers came out with a rule. They're like, enough. We never required you to report shareholder basis. They got sick and tired of accountants actually not doing this. And what happens is that they said, enough, from now on you will be required to do it. Honestly, it was music to my ears. Because when we signed up new clients and we want to properly calculate their shareholder basis, which actually affects the tax consequences when they take out distributions, a lot of accountants didn't calculate it. They were too lazy, they never kept track of it. And a lot going on with their business, I would look at it and I would be surprised that the accountant would ignore that. But now IRS made it a requirement and most tax. That is actually good news. All right, cool. Next question.
Follow-up questions from Dave. Is there anything in the above home office, occasional rental of a portion of the house that can disqualify this? I'm specifically making a distinction of renting the single room on Airbnb versus renting the whole room for the Augusta exemption.
What's the question again from Dave?
Is there anything in the above home office / occasional rental of a portion of the house that disqualifies this?
Okay, Dave is asking a follow-up question. Is there anything that I'm doing that disqualifies me from taking home office, Airbnb, or Augusta? Not from the information that you gave me, at least from this YouTube live. I think you're good to go there. Next question.
Robert said you answered this question. Thank you so much. Chris is asking, as an LLC with an S-Corp status, do we still need to make estimated tax payments? Are the withholdings in Gusto basically the estimated payments?
Got it. So this is Chris, right?
Yes.
Okay, I wrote the LLC. Okay, so Chris says I have an LLC that is filing as an S-Corp, right? And do I still need to make estimated payments?
Yes.
Or does whatever's being taken out from Gusto is enough? The answer is what Gusto is doing is just your W-2 salary. That is your salary, and they're taking withholdings from that. Now you have what's called a profit from a business. You do need to file estimated taxes on that. Gusto is only withholding taxes on your W-2. Cool. All right, guys, we do have a hard stop at 12:55 today, okay? So we're going to go through questions a little bit quicker. For those of you that are participating, Marianne over here is taking your name down. For those of you that do win today, we'll get an S Corporation Tax Secrets book, are going to get Thinking Outside the Tax Box mailed to them all for free. And the third winner, if you're a business owner, we will review your business and personal income taxes. It'll be reviewed by a tax advisor. For those, if you are listening to this live and you're interested in working with us for your tax advisory, say yes in the chat. And if we have a yes, we'll send you a link where you can schedule a call with my team. All right, next question.
Question from AJT named Anthony. If I bought some land, held it for 3 years, then sold it to a land developer and was only paid some of the total proceeds at closing, but then yearly receive a small percentage of the home sales prices for property sold on that developed land, how are these yearly proceeds from the percentage of the home sales taxed and reported?
I'm guessing you're going to have what's called an installment sale. That's my best guess from the information that you're giving me. And speak to your tax advisor to set it up properly where you don't pay tax on the entire income that you receive for the sale, but you pay tax only on the money received. Next question.
Okay, Douglas, if I participate in my W-2 job 401k retirement plan, can I still set up a SEP with my S-Corp?
Yes. So, is Douglas, you said?
Douglas.
Douglas is asking an excellent question. Douglas says, hey, Boris, I've got a W-2 job and they give me a 401k. Can I also set up a SEP for my own business? You can, as long as the total contribution between a job and your SEP doesn't exceed annual thresholds. And I believe the annual thresholds this year are $63,000. Fact check me on that. But I think annual thresholds are $63,000 or $61,000. Next question.
Follow-up question from Jason. In the late filing, can I add contributions for 2021 IRA if I didn't file the S-Corp tax yet?
No. Next question.
Question from Ad Machines. Steve, I am thinking of setting my wife up as a real estate professional to cost segregate my rentals. Would you recommend starting it on the first of a year or mid-year?
As soon as possible.
Question from Chris. In an S-Corp, as income increases, reasonable compensation generally stays the same?
Depends. Do your responsibilities change? Do you do more for business or do you do less for business? Generally speaking, what I've seen with our clients is that the reasonable compensation does increase because their responsibilities increase, their role increases. You can be a CEO and not a worker anymore. You can be a sales manager and not a salesperson anymore, and so to speak, right? Next question.
Okay, question from Anthony. Can I use the Augusta rule in both my primary and second home?
Yes, you can.
Question from Aaron. Is home depreciation different than reimbursing for part of the mortgage payment as a part of the home office expenses?
You reimburse yourself for the depreciation expense as well.
Question from Yohanan Niazov. How do you know how much you can deduct for home office with an S-Corp?
You measure the square footage of your home. So basically what happens is that you've got a home, let's say it's 1,000 square feet. Your home office is 200 square feet. 200 divided by 1,000, that's 20%. Now, all expenses related to your home are deductible up to at 20%. Next question. Sorry, guys, I'm going a little bit quick today because we have a hard stop at 12:55. We usually start with the questions early, and I go very detailed and deep. So next week, if you want something more detailed, just come on a little earlier, but we are going to try to get through all the questions. By the way, for those of you that participate the most with the questions, right, we're going to be sending this book to you, Thinking Outside the Tax Box. This baby currently goes on Amazon for, I think, 21 bucks. This is an S Corporation Tax Secrets book. That's the second winner. And the third winner must be a business owner, and a tax advisor from my team will personally review your tax returns. For those of you that are interested in working with us on your tax planning and tax advisory, say tax planning in the chat or say yes in the chat. We'll go ahead and put that link. Marianne, do we have any yeses there? Maybe we can start putting the links before we start and continue with questions.
Just a second.
Perfect. Let's put in the link, please, okay? For those of you that want that link, we're going to put it right now, but it's www.taxplanningcall.com. Again, that's www.taxplanningcall.com. www.taxplanningcall.com. Let's continue with the questions.
Okay, question from Jason. Is it possible to include Augusta rule on past filings, and can out-of-pocket medical type expenses like chiropractor be reimbursed and S-Corp deducted?
Okay, that's a two-part question.
Yeah.
So Augusta cannot be deducted for past filings. You can go ahead and amend it. Look, hey, we want to use Augusta unless the checks went out from the business to personal. There's been documentation. Everything has been documented. The lease agreements have been done, and you just missed the deduction. then I would argue yes. But if it's like, hey, we did hold the meetings, but there's no documentation, no payments going out from the business to personal at that point at the time of the year, that tax year, should not be amending the return. What was the next second part of the question?
Can out-of-pocket medical type expenses like chiropractor be reimbursed and S-Corp deducted?
Chiropractor, from your HSA account for the chiropractor, of course, if it's medically needed. And I think we are 12:55 on the dot. We've got some comments here. The last comment I see, great questions, everyone. You're addressing some things I didn't even think about. Steven, get a tax advisor. All right, cool. Let's give away the prizes. So first one, we're gonna go with the thinking outside the tax box. By the way, in order for you to claim this, I don't have access to your information on YouTube, even if you're subscribed. I don't think YouTube allows us to see that. So what we're gonna ask you is, we're gonna give you our email address. Email that address, the winner, okay? Dave, you're welcome. And then we're pretty much gonna mail this to you. All right, so Mariana, who's the first winner?
Okay.
Oh wait, are we gonna do the
oh, you want to do
what do you
that?
call that? Yeah, pick out the names, right? Mariana is doing the names. We'll take a couple of questions. So I see the screen, I can only see the last questions while Mariana's doing that. Anybody has any questions, let me know. I'll still take a couple of questions while Mariana is getting